name is Maxwell Emmanuel. I'm a forex trader. In the next few minutes, I will be teaching you how to manage risk in trading. It is very important that to achieve success in trading, you understand the risk in trading and you should be able to manage the risk. How you manage risk in trading will determine how long you're going to stay in this business. It will determine how profitable you would be in this business. So before you start trading, it's important that you define the risk you want to take, and you must ensure that the risk you would be taking in the market is what you are comfortable with. And that is why you are advised before you invest in the financial market that you should only risk money you can afford to lose. Reason for that is that when people invest money that is critical to them, that they are not willing to lose, they put too much pressure on themselves. And when you're trading under pressure, there's a high probability that you're going to lose money. Okay, so invest money you can afford to lose. So before you start trading, you should know the risk involved in trading. Okay, and I will be using the board. Okay, explain what risk you should take in trading. Like I said, you should define the risk. Okay, you should define the risk you will be willing to take in the market. So let's say you want to start trading with $1,000. Let's say this is your capital. Let's say this is your initial capital, $1,000. Okay, let's say this is your initial capital. You are advised not to risk more than 2%. If you are a beginner, you shouldn't risk more than 2% on every trade you execute. Now, before you start trading, you should have a strategy. Very important. You should have a strategy. Your strategy is what tells you when to buy or when to sell. Your strategy is what tells you when the trend is changing from bearish to bullish or from bullish to bearish. So you need to have a trading strategy. That's the first thing you need to get. Now, let's say your capital is $1,000. Okay, you are advised as a beginner 2%. What that means is that on your $1,000, you shouldn't risk more than 2% of $1,000 is $20. Okay, so your risk on a trade should not exceed $20. Now, there are two types of risk in the market. We have market risk and we have capital risk. So what we just defined is your capital risk. Okay, you shouldn't risk more than $20. Now, the market risk is the market that defines that. Okay, and your strategy will also help in knowing the risk involved on any trade before you execute it. Your strategy. So, for example, the strategy I use, the maximum market risk I take is 40 pips. That's the maximum market risk I take, 40 pips. Okay, so since I'm willing to risk $20 on every trade and the market risk is 40 pips maximum on every trade, it means now I want to know the lot size, the volume of currencies I'll be able to purchase with my $20. Okay, you need to know the volume, the lot size. You need to set those things before you execute the trade. You need to know these things before you execute the trade. So if the market risk is 40 pips and I'm willing to lose $20, what volume of currencies would I be able to purchase? So right now I'll be dividing this $20. It's like you're sharing the $20 amongst 40 people. Okay, so if you share this among 40 people, what you will get is 0.50. So if you share $20 amongst 40 people, each person would go on with how many cents? 50 cents. Each person will go on with 50 cents. And if you multiply this 50 cents, okay, by 0.1, what you will get is 0.05. So in trading, 0.05 represents 0.05 lot size is 50 cents per pip. Okay, 50 cents per pip. So if you multiply 0.05 times 40 pips, okay, 1 pip of 0.05 equals to 50 cents. So if the risk is 40 pips, multiply by 0.05 what you would get is $20. I hope you're following. So this is if the trade goes against me, I wouldn't lose more than $20. Now, after you've defined the risk, you've defined the market risk and the market risk, and you've also known the lot size you would apply on the trade, the next thing you need to define is the reward. How much are you going to make for this risk you've decided to take? For every risk you take, there should be a reward. There should be a reward. Okay, so you need to know the reward. And as a beginner trader, you are advised not to use risk reward below 1:1:2. Okay, your risk reward should be 1:2. What this means that for every $1 you are risking, you should make $2 on that trade. So if your risk on the trade is $20, you should expect to make a profit of $40. You should expect to make a profit of $40. And to make $40 with 0.05 lot size, that will be 80 pips. So you are risking 40 pips, the market risk is 40 pips, and you are expecting the market to give you a profit of 80 pips. That is how to manage risk in the market. That is how to know the lot size you are to trade with in the market. I hope that is clear. If you have any question, you can drop it in the comment space. It is important that you understand the risk involved in trading, and you should be able to manage risk. Okay, what I just taught you is how professionals manage risk. Okay, you must understand that trading is a game of probability. There is no guarantee that you will win all trades. Okay, there's a possibility of you losing 50% of your trade and winning 50% of your trade. So if you apply a risk reward of 1 to 2, like we have it here, we are risking $20 to make $40. If you lose 5 trades, let's say out of 10 trades, you lose 5 trades, that will be $100 loss. And if you if you win 5 trades out of 10 trades, you're making $40, right, on every trade. So 5 trades will be $200. So at the end of the day, when you subtract this from this, you'll still be in profit of $100. But if you apply a risk reward, let's say you are risking $20 to make $20. This is risk reward 1:1. Okay, 5 trades you make $100. 5 trades you make $100. You also remember that your broker will charge you commission. So if you apply 1:1, in the long run, you won't be profitable because your broker will charge you spread. They will also charge you commission. So this will not make you a profitable trader. Risk reward 1:1 won't make you a profitable unless you have a strategy that has at least 80% winning rate. That is when 1:1 would make you profitable. But if you trade with 1:2, you definitely be profitable. Even if you win 6 trades, let's say you lose 6 trades out of 10 trades, you will still be profitable trading with 1:2. If you lose 6 trades and win 4 trades, you'll still be profitable. Let's do that. So you executed 10 trades, you lost 6. 20 times 6, that's 120, right? And you won 4. 40 times 4, that's 160. At the end of the day, you'll still be in profit of how much? That's $40. You'll still be in profit. See why a good risk reward is very important. Good risk reward. You need to apply at least 1:2 good risk reward. And if you have a good strategy that can give you 1:3 and above, trust me, you'll be profitable in the long run. You'll be consistently profitable. The reason most traders lose money is that they are trading with risk reward that is less than 1:1. Some traders trade with risk reward 1:0.5. They are risking $1 to make 50 cents. You can never be profitable in the long run with this strategy. You can never be profitable. Even some risk $1 for less than 10 cents. These are the type of traders that tell you a bet at hand is worth more than 10,000 in the bush. Anytime they see profits, they close it. Anytime they see profit, they close it. They forgot that the risk they are taking is higher than the reward, than the profit they are going for. So in the long run, they will keep losing. This is why 90% of traders lose money. Poor risk reward, poor risk and money management is the reason. So if you want to be profitable in your trading career, in your trading business, you should start applying proper risk and money management. Apply good risk reward, and you begin to see tremendous changes in your trading profits. Okay, I am Maxwell Emmanuel, the profitable trader, committed to your trading success. I'll see you in the next video. Till then, keep winning.